For those that don't know me, my name is Chris Lestrino. I'm the founder and CEO of Kingscrowd. We're kind of the one-stop shop. Think of us as a Bloomberg Morningstar investment research service focused specifically on the Reg CF and Reg A equity and debt markets. And one of the initiatives that we undertake is on a pretty consistent basis. I'd say about once a month, we like to have a sponsored educational webinar where we bring in an asset class that we're not currently covering to help teach you about other alternative investments that are out there that we think could be really interesting as you think about diversifying your own portfolio. So I am really excited for this conversation today. This is actually one, I'll be honest, I had not seen before until recently when we learned about the Energea team. And I was so excited to learn about it because I've known about this asset class and know how hard it is to get into it. And so to see them working on providing access to the solar project investment opportunities, I thought was really, really interesting. And certainly the best execution I've seen across the alts landscape to date. So I think it's going to be a very, very interesting conversation. I'm going to kick it off in a second to Mike and Tyler from the Energea team to go over what they're all about and how it all works. And then I'll take some questions to the team, and then I will open it up to the crowd as well to ask any questions you have. So as you have questions, please enter them into the chat section or the Q&A section, preferably the Q&A section, and we'll make sure to get to as many of them before the top of the hour as we can. So with that, Mike, Tyler, thank you so much for being here. I'd love to get a little bit of background on yourselves and get into what Energea is all about.
Yeah, thanks. So before we actually get started, thanks, Chris. I'll just give a quick introduction and then I'll kick it over to Mike. So my name's Tyler Hurlbert. I'm the Director of Investor Relations here at Energea. I've been with the firm since mid 2020. And I come from the financial services world. So I was a financial wealth advisor, financial advisor for 20 something years before joining Energea. And really got to the point where a lot of the things I was investing in and was interested in investing in personally, those were things that were kind of taboo or off limits to talk to with clients. And I said, well, these are things I'm interested in. I believe in them. I need to, do something where I can invest in these things and kind of align my values a little bit better with what I want to do. So I joined Energea, haven't looked back, really building a diverse section of investors here that are looking to add alternatives to their portfolio to add some diversification and increase the return of their portfolio. So couldn't be happier to be here with Kingscrowd, and I'll let Mike give a quick intro as well.
Sounds good. Thanks, Tyler and Chris. Yeah, we appreciate you having us on here, and hello to all who are watching. My name is Mike Silvestrini. I've been participating in the solar energy industry since about 2007 when I founded a company called Green Skies. Over the following 10 years, we grew that to one of the largest commercial and industrial solar companies in the US. We were fortunate to have customers like Walmart and Target and Amazon in the first phase of this industry's maturation. We did very well in a time when the industry was still nascent. My partners and I exited that business in 2017, and I started Energea with my friend and longtime colleague, Chris Sattler. And we've been able to put in place something that we thought was really necessary to exist, where we can allow more participation from a much broader base of potential investors in this asset class that we know and love so much. It's a tricky asset class. We'll explain to you, how we view this asset class throughout the webinar here today, and try to get you guys familiar with the lens through which we view solar energy and how to make money doing it.
Great. Awesome. We're going to take about 20 minutes. We're not going to try to spend too much time on the deck. We want to allow plenty of time for Q&A and have Chris kind of moderate a conversation. But we're going to talk a little bit about Energea, what we are, what we're all about, performance, the portfolios, why we like the investment funds and portfolios we've selected, and then get into a little bit of kind of some frequently asked questions, how to go about investing with us. And like I said, leave some time for Q&A. Obviously, we're not soothsayers here. We don't know the future. If we did, we might not be on this call today. But this is just saying, hey, listen, we don't know what's going to happen. If we make forward-looking statements, they're our best guess, and take that with a grain of salt. So first off, foremost, I feel like we're at this point right now. If you read BlackRock and Larry Fink's most recent letter to investors, There's this convergence of energy infrastructure. The world needs more energy with AI and data centers, and just in general, we need more computing power. We need more power and energy in general. So we need more energy infrastructure. We also now have this convergence where private investments and private markets are becoming more readily available to the retail investment space. So our job here at Energea is really to connect investors to these private markets and these opportunities that were once only available to the BlackRocks of the world. Now they're available to you. And obviously the folks over at Kingscrowd and this audience know about that. So that's really where the Energea investment platform kind of comes in, is right at this kind of center of the need for more energy infrastructure and the democratization and kind of access to private markets for retail investors. You see here quickly just a little bit about our performance. I always refer to these as the most beautiful, boring investments in the world. You're never going to see these investments up 30%. You're never going to see them down 30%. So if you look at this performance chart, very steady performance going back to 2020 for Energea, from anywhere from 11.3 to 13.7% IRR, realized our IRR on the platform. So we kind of have this chart here where we compare that to publicly traded REITs in the S&P 500. And you'll see just a very steady kind of investment class, non-correlated to public markets, which we really love, really adds some true diversification to your portfolio. Steady returns, but also we pay monthly dividends. So it's really that passive income, steady income based on contracts that we particularly like. So I'll pause here for a second, pull up. I'm going to let Mike talk about, probably the number one question I get is, when I invest in Energea, what am I actually buying and how does this whole thing kind of work? So we'll talk a little bit about that, and then we'll get into the three open portfolios and funds on the platform right now in Brazil, the US, and Africa.
Thanks, Ty. And obviously, this is going to be a really high-level discussion today. To get more in-depth details, pick up a copy of an offering circular, thumb through it, and really understand what our products are and how they work. But essentially, we create a Delaware-based company, and those are those light gray boxes there. You have LATAM, you have Solarized Africa, you have USA and Brazil. These are holding companies, as we refer to them. They have no employees, but they are companies, and their exclusive purpose in this world is to own a number of underlying assets. And we refer to those here as SPEs, single purpose entities. Or in the case of South Africa, it's a holding company that owns the projects directly. So what we want to do is get the cash flow from the projects that exist in those dark green boxes up to our investors. So each month, as the solar energy projects produce energy and we invoice our off-takers, and those off-takers pay for that energy, there's some operating expenses at the project level. Then the money goes up to those light gray boxes. It zaps over to Delaware. Usually it's coming in from multiple currencies and multiple jurisdictions. We're aggregating that all in Delaware. And then that is a company that you can buy shares of. So if you own shares of our LATAM portfolio, you get entitled to a pro rata portion of the cash flow coming back up from those project SPEs. So what we sell on our platform is Class A investor shares, so stock in these light gray boxes, each representing a specific investment thesis. And we're going to walk you through sort of why did we select these markets? Why do we go through the pain and suffering of investing in places like Africa and Brazil and Colombia? There's a very good reason why. It's because we feel like there's an opportunity to make oversized returns if you're willing and capable of going into the places where capital is very expensive.
Yeah, and I think, Mike, one of probably the most important part about this investment structure that I see, many on this call may have heard of yieldcos, things that, investment vehicles where you could invest in some of these energy infrastructure projects. This ties you directly to the cash flows and the dividends and the income distributions from the sale of electricity. So you are very much a direct equity owner in these projects through this investment structure. And that's what really allows us to provide, larger returns than you typically see in a yieldco investment historically.
And the last thing I would say, Tyler, is you have Energea Global sitting there on the side. Our job is, as the general partner, is to make the decisions about what we invest in and make the decisions about how much to distribute on a monthly basis. And, if a customer's not paying, it's our job to call them and make them pay. So that's exactly our role in this. We are not shareholders. You're the shareholders. We may buy shares. We actually are shareholders from time to time as well, exactly in the same way that you'd be a shareholder. But our general role here is as general partner. And the way that we make money is that we charge a fee to these light gray boxes, to these yield cos for those services, which is detailed in the offering circular. So you don't have any employees to worry about. There's no expensive vacations or, first class flights that goes into the operating expense of the company that you are an owner of. It's just owns projects. And when there are expenses like the ones I just described, those are borne by Energea Global as a general partner. And there's very clear rules for how we are paid fees. And then we use that money to pay for our team and provide you guys these services. So let's start off with the flagship portfolio. Going back to 2017, Chris Sattler and I knew that there was something brewing in Brazil. It's an enormous energy market. It has tremendous solar radiance. Energy is very expensive, and it had almost no solar. And specifically, it is reliant on hydro energy, which is subject to fluctuations in hydrology and exposes your pricing and your energy availability to things you don't want to be exposed to. We knew solar was coming, and that's exactly what happened. Chris moved down to Rio de Janeiro sometime around 2018. We started investing in our first projects right around that time. And then by 2020, there was so much inventory available to us that we decided to open up our first retail product so that others could come and participate alongside Chris and I in this investment thesis. What we really like about this market is that it's what we call community solar here in the US, which means that these projects that we own, you can see Divinopolis and Iguatama here, those projects are selling power to hundreds or thousands of individual residential and businesses. So people come through an online portal down in Brazil, energea.com.br, and through there, they can subscribe to benefit from our energy products. As we produce energy, we allocate that electricity to those subscribers. As they benefit from getting those energy credits, we send them an invoice, which they pay, and that creates our revenue. And what we really like about that architecture is that we're not contingent on any particular credit. In a place like Brazil, some businesses, even big businesses, are not credit worthy. You wouldn't want to bet the farm on any particular business or home in that country. So what we want to do is we want to have a broad base of clients who can participate at their leisure. And if they should not pay us for any reason, we can replace them very quickly with another customer from the queue. And we like that policy a lot. We have complete control over the asset. It's on land, which we control, and the returns are very high. Projects in Real start off in the low 20% cash yield for a 20-year power contract. By the time we convert that into dollars, and then we pay some operating expenses, including Energea's fees, our return to investors after has been 14%. Not a bad day's work for selling clean energy to a variety of off-takers. This market continues to be white hot. We're very well positioned there. And our opportunity to make money in Brazil has really just begun, even though we've been doing it for the last 5 years. There's a lot of projects for sale. We can buy projects at prices lower than it costs us to build them. And we have now a deep familiarity with the utility companies and the way that these projects operate. So there's a reason why most of our clients invest in community solar in Brazil, and it's because it's been such a fat producer.
Yep, absolutely.
Meanwhile, solar in the USA, we view this as sort of a necessary evil. It is not the highest yielding market that you can do business in. Everybody knows it's a sophisticated market. There's lots of competition. There is a lot of solar energy assets, but they're very complex because we have tariffs and we have tax equity investments and things that make what could be a simple yield turn into a brain damage exercise. Nonetheless, we've found a way to invest in solar energy projects in the US and try to avoid a lot of that complexity. And we do that by buying projects that are already operational. So somebody else has gone through the brain damage of working with the utility companies and paying the tariffs and getting the tax credits and monetizing those tax credits long before we come around. And then we're looking for the straight cash yield. So we want to buy a project that's already been going for a little while. We step in, and on day one, it's going to contribute cash flow into our dividends pool back up to our clients. It's hanging tight at a 7.1. The Fresno Yosemite Airport project position pictured here is probably the anchor project of this portfolio right now. And then it's got another few projects in the New England area and in California. We actually just bought a new project this week in New York, which is a community solar project, which you just learned about when I explained it in Brazil, because New York has a similar policy, and we sell the energy from the plant to the town of Catskill. So we'll continue to place capital into these projects. We have tremendous relationships in the solar energy industry domestically here. So it's we see a lot of inventory and a lot of opportunities. We're very selective, and we think we've got a great book of projects that will stand behind our projections for years to come in this US portfolio. Then there's Solarize Africa, which is really a fascinating opportunity. I've studied Africa. That's where my master's is in. I was in the Peace Corps in Africa. I have a nonprofit in Africa. So I've always had a longstanding relationship with the continent as an interested party. But it became good business only in the last few years. And what's happening is there are pockets of opportunity starting to evolve in Africa where we have a manageable level of risk. The reason why that's happening is, number one, you have markets like South Africa, where the bulk of our inventory is today. And South Africa actually has some very creditworthy customers. Pictured here is CPOA, which is a retirement community, a massive real estate company that has provides housing to the elderly. It's been around for a long time. They have a tremendous balance sheet, and they pay their bills. I like this customer. And they needed access to solar plus batteries so that their facilities can run even when the grid flickers. And when you live in a place like South Africa, that happens a lot. There's not enough energy on South Africa's grid to service all the demand coming from all the clients on that grid. So a lot of our clients are defecting from the grid and going with solar plus battery solutions. And we lease them that equipment, and we own the equipment. And we have 100% payment rates. We have never had a defaulted customer in South Africa, and it's working according to plan. There's a lot more where this came from, but we also see Africa expanding because there's larger format project opportunities in Africa right now. We, through a debt product, also from this company, that's important to mention, we buy projects and own them, but there are some cases, whether it's for tax reasons or for risk management, where we would actually prefer to lend money to a project instead. So we do both. This portfolio has both debt and equity positions. And what we're doing is we're lending money to a developer backed up by significant collateral, and they're using our capital to develop 3 large-scale projects in Africa, 50 megawatts, which is enough to power tens of thousands of African-scale homes in Sierra Leone, in Botswana, in South Africa. We're chomping at the bit. We're playing a very close role with the World Bank, and we're trying to convince some of these multinationals, these DFIs, if you will, that where they can get the most bang for their money is to guarantee power contracts. Because if I have the credit of someone like the World Bank behind a power contract in a place like Sierra Leone, it doesn't feel like a deal in Sierra Leone anymore. It feels like a deal with the World Bank, and we can depend on that cash flow. And that is starting to open up opportunities in Africa for larger, more sophisticated transactions, and we have a front row seat to that. So thus far, this project has done really well with the commercial and industrial segment in South Africa, but we see it moving more towards utility scale opportunities as we start to pull in some credit support from multinational institutions, and seeing this market, which no market needs energy more than Africa, start to get our investors' attention.
Yeah, Mike, at this point, one of the questions I often get, heading up investor relations from investors is like, how should I diversify across all these portfolios, right? So I think like any investment, the more you can spread out, your total investment across, different geographical areas of the world, different governmental policies, different currencies, it's going to benefit you as an investor. So the way that we and while we don't give specific investment advice on how to allocate portfolios, I think a mix of the three does make sense. These are all risk-adjusted returns, right? So going back to Brazil, you got a 14% return. Here in Africa, it's just about 10%, and in the US, just over 7. When you blend those portfolios, together artfully, you come up with this really nice cocktail of double-digit yield and a lower risk, investment income that's backed by contracts, and this kind of steady engine in your investment portfolio that just is always there as the sun's shining to kind of churn out dividend payments and distributions and income to you, and be a diversification factor. So at the end of the presentation, there'll be a slide where you can kind of scan a QR code. I would encourage all of you to check out our website at energia.com, scan that code. That'll go directly to my calendar, and we can talk more about how to build that perfect portfolio for you. But I think a blend of all three of these portfolios is ultimately the best way to go. So with that in mind, some of the frequently asked questions that I get, every day at Energia, what are the terms of this investment? How liquid is it, right? So there's a 3-year investment hold. So any principal investment that you make on the platform kind of needs to stay there for 3 years. These are real energy infrastructure assets. It's not as if we can go sell a piece of a solar project to kind of provide liquidity to an investor. So we recommend that you hold for at least 3 years. We realize that emergencies come up and things happen. So if you have to sell before that 3-year period is up, we do allow you to do so through the platform with a 5% early exit penalty to access that cash. And that penalty goes right back to the portfolio investors. So the folks that are in it long term benefit slightly, from investors that need that liquidity and need to sell early. From a tax standpoint, these Delaware entities that Mike talked of, we treat them like a corporation for tax purposes. So you're going to get a 1099 div at the end of the year on these investments. So long-term capital gains tax treatment, which is certainly better than ordinary income for most folks. So we like that. Another question I get on taxes a lot is like special tax benefits, tax credits in the US, things like that. We monetize those tax credits or any incentives there that we get from a tax standpoint and just distribute it back to investors in the form of the monthly dividends and distributions. So you wouldn't be able to claim those tax benefits. Most people don't qualify to do so anyway. So we would just rather give that money back to you in the form of a yield and keep it simple from a tax perspective. Very low minimums, right? So when we started this platform, 4 or 5 years ago, we wanted to be very conscious that, people are going to want to test this out. We might have college students looking to kind of put $100 a month in for their future. So the investment minimum is $100. It's open to both accredited and non-accredited investors. If you're accredited, there's no limit to how much you can invest. If you're non-accredited, you're limited to 10% of your net worth or annual income, whichever is greater, and that's per fund per year. So it doesn't run into major problems for most people with the limits. And we do have an IRA option. So we've partnered with an IRA custodian called Inspira Financial. And it's real easy to open an IRA or a Roth IRA right from our website, right from the Energea platform. And then you can either contribute money from a checking or savings account, make contributions, or you can roll over funds from an existing IRA or Roth IRA. So if you're interested in that, definitely let us know, and we can walk you through it. Why Energea, right? Like we've touched on a few of these points. We call these kind of our pillars of why this is a sound investment that every portfolio should have. But energy infrastructure, alternative investments in generally, certainly in Energea, it's not correlated to the stock market, right? So the stock market's going sideways or it's going down, it doesn't really have much of a bearing on our solar portfolio in South Africa or in Brazil or even in the States, by buying operational assets. So it does provide true valuable diversification to an investment portfolio. When I was a financial advisor, that was one of the biggest things we looked for, was trying to provide non-correlated investments to US markets, fixed income and equity markets, to provide that diversification, because lately everything kind of moves in tandem. Even things like cryptocurrency, if the market's up, cryptocurrency is doing well. If it's down, it's not doing so well. So these investments really do provide that true diversification. Obviously, it's passive income. So every month we pay dividends on those higher level companies that Mike talked about that you own shares of. So every month we collect revenue from the projects, distribute it back to the states, and then to our investors in the form of a monthly distribution or dividend payment. So it's kind of long-term passive income, which we like. We feel like it's, unless you're 100% in the US, which not many of our investors are, it's going to be a double-digit IRR, so 10% plus with monthly dividends. We really like that. And then obviously stable long-term cash flows. So before we even put a shovel in the ground or buy a project that's operational, we have a pretty good idea through, we've done this before, modeling these projects to know how bright is the sun going to shine? What are the costs going to be to maintain this project from a maintenance, taxes, insurance standpoint? So we really have a good idea. They're generally inflation indexed, so kind of, whether electricity is going up or inflation's going crazy, we're poised to capture that upside. So again, from a real asset, I think that's what you want. You want the non-correlation, but you also want the inflation protection, so that these contracts, these contracted dividends can kind of continue to rise throughout your retirement years. Real quickly, kind of how to invest. The first thing to do is just to create an Energea account. So simply by going to energea.com and putting in your email address and creating a password, you can create an account. And Mike had talked earlier about the offering circular. A lot of the documents that we provide to the SEC and things that you'd want to start to do some research on from a due diligence perspective, they're behind. You have to have an account to see those documents. So you, just by putting in your email address, creating a password, you have an Energea account. Now you can start that process. You can talk to us. We'll help you build your solar portfolio with as little as $100. And then you collect the dividends along the way as the projects produce electricity, and we collect that revenue. So you have the option to either reinvest those dividends automatically if you don't need the cash right away, or you can certainly take the dividends as cash and have them sent directly to your Energea wallet and then to your bank account, if you plan on kind of using that passive income as an income replacement strategy. So pretty simple stuff. Takes about 6 minutes from start to finish. I think we've got it down almost 5 minutes now if you're quick on the draw from a tech standpoint to open this account. And any questions, feel free to direct them my way. If you want to take a screenshot of this, Tyler@energea.com is probably the best way to reach me. My phone number is there as well. And then if you scan that QR code, that'll bring it directly to my calendar. And I'd love to take 15, 20 minutes, a half hour, as long as you need, to chat with any of you today and kind of get you comfortable with the investment, the offering itself. And I guess with that, we'll pull up and Chris, certainly take any questions that might have come in.
Yeah, thank you so much, guys. This is fantastic. So I have a handful of questions that came up for myself as we were going through this, and then I'll turn it over. I have a bunch of questions coming in as well. So first thing I'd love to understand is you talked about kind of having complete control of these projects, the land, so on and so forth. So help me understand, is this like in each project, is there almost an equity ownership piece that's there? And if that is the case, and you're controlling everything from end to end, is there like a final sale of the project after 10, 15, 20 years? And do investors in the fund get to partake in that as well? Or is it really just the cash flow distributions that you're buying into?
That's a good question. The reality is that the projects probably do have some residual value, but it's not in the form of the equipment. The equipment depreciates. The solar panels depreciate, the inverters depreciate, the wire depreciates, the piping depreciates, the trackers and motors depreciate. So we're expecting the projects to basically, depreciate to zero after 20 years. But that's not the end of the story. And we call it zero. So when we talk about the value of this, the return on investments and the future projections, we call it zero. But between you, me, and the lampposts, Chris, I think it's actually a lot more value there. Number one is that we have an interconnection spot. It's a node along the capillary system of the energy grid that is going to want to have a power generator there, a distributed power generator there for possibly for centuries. So will we be able to put a new project right there? Sure. And anything that we're able to create for additional value belongs to the investors. The investors, not us, owns that location, owns that connection point. If there's salvage value and selling the project for a second life, that goes to the investors. And it's our job to just try to optimize that for you, but not to overpromise. So the answer is there's probably a lot of value. But unlike real estate, where there's always this sort of magical exit that completes the return profile, we were really not comfortable doing that. Could we sell these projects in 5 years at a great discount rate and everybody makes a tremendous return? It is possible, but we do not hold that assumption, unlike what we see in real estate.
No, it makes a lot of sense. And you also mentioned that, with these projects, you want to have buyers of the energy kind of already in place. What do these buyers look like? Are they energy companies? Are they businesses? What do they look like?
We have a range. So I'll give you some examples. Out of the US portfolio, we have Eversource is one of our primary off-takers, which is a utility company here in the Northeast. You would know, being in Massachusetts, you'd know those guys. We have the city of Fresno, which owns the Fresno Yosemite Airport, is one of our off-takers. We have the city of New Canaan, Connecticut, arguably the wealthiest zip code on planet Earth. Very good credit there. They pay their energy bill at the school that we've solarized. So that's one credit story. You go to a place like Africa, you have different credits. It's C&I, or commercial and industrial customers. And that's where, we've locked arms with this retirement home business that we really liked the economics of their enterprise. We have some manufacturing clients over there. We have a couple different types of commercial and industrial customers in that portfolio, but most of them are facilities of long standing. There's a clinic for people who need mental assistance. And it's part of the fabric of that society. That building's going nowhere for a very long time. We like that credit. And then go down to Brazil, where you see the community solar element, where we have hundreds, of pharmacies and bakeries and even homes who have subscribed to the projects. And while, we like the credit of our customers, about 2% of the time they don't pay. We projected that. We actually expected it to be 5%. But it turns out it's more like 2% of the time our customers don't pay us in Brazil. So that's okay. We replace them with another customer and the train keeps rolling. So as long as we hit our projections or better, we're happy. We don't expect everybody in Brazil to pay all the time, and they don't.
In terms of who develops these projects, are there specific solar developers and you just have relationships with them and then go in and decide which ones you want to purchase?
Yeah, the way we look at this, Chris, first we kind of identify a market segment that we're interested here in our offices. We identify an opportunity that we think is going to hit. And then we approve that market through our investment committee process, full due diligence rake on any particular country and segment within that country. Then once we found something that we like, we're going to look for the developer partners, who's on the ground, who's got the boots on the ground, who has the sophistication, the experience, and the proven track record to be able to materialize our investment strategy. Then we select 1 or 2 or maybe 3 of those. And then they start piping in projects, and then we start looking at projects. And then eventually there's a market due diligence, there's a developer partner, and then there's a project due diligence. By the time we get one in the bag, we know what we're doing.
Now, you mentioned, there's no kind of perfect moment of return, like with real estate. Hey, we're going to sell this property in 5 years, whatever. So is there a time limit on returns? Or do you kind of continue to get returns in perpetuity on these things?
So basically, your return is split between 2 different components. One of them is your cash yield, and the other one is the value of your stock that you're holding. And the value of your stock that you're holding is where we deal with this particular issue. What we don't want is a secondary market where Chris, who owns a stock, is going to sell it to Tyler, who wants to buy the stock, and they're going to agree offline to some price that may or may not be a good price for one of you. We don't want that, because the price of the stock of an energy portfolio should be the net asset value discounted to today's money. So that's how we set the price. We take the net present value of the future cash flows at a discount rate equal to the IRR of the portfolio. And that's what this thing is worth divided by the total number of outstanding shares. So as that time marches on, if I introduce a new project, I'm increasing the amount of free cash flow that's available in this portfolio. And therefore, the stock price is going to go up. If I don't do that, it's going to depreciate to zero. Like we said, your stock is going to be worth zero, but you'll be okay with that because your dividends will comprise all of your return. So it's really this relationship between giving Energea the flexibility to continue to raise money and to pursue great opportunities, but being fair about the status of the portfolio as the amount of future cash flow goes up and down as we buy or depreciate these assets, and making it always the same return for you or for the guy that comes in a year from now who might buy that stock from you, but at a price that we set.
Yeah, Chris.
Well, actually, go ahead, Tyler.
No, I was going to say we get this question all the time. It's probably one of our most common questions is kind of how do you compute the share price and how do you do that? And I think I always kind of settle on with investors. The only reason there is a share price is because these are evergreen funds and they're open ended, and we're constantly adding new projects and distributing cash. So we needed to figure out a way to equalize investors over time. So an investor that comes in today versus somebody that comes in a year from now or 3 years from now, we need to have a system in place that makes it completely, fair to all those investors that might be buying or selling, coming into these funds at different times. So I think, as Mike mentioned, when you make it all about the cash flows, how much cash has the portfolio distributed versus how much future cash do we expect to distribute, discount those cash flows to come up with a value of what the shares are worth today. We thought that was the only fair way to do it. And, to be honest with you, some of our, kind of companies that have come before us and tried this, it's been more invested in a project, one singular project versus a portfolio. And I personally feel like the fact that we have this evergreen portfolio fund concept is what makes us different. And it does allow for investors to benefit from diversification, because I can tell you one thing, knowing what I know, you do not want to own one solar project. You'd much rather own 20.
Well, actually, two questions off of that. First off, someone had asked a very pertinent question to this very specific topic, which is, are there any current or planned secondary markets for shares in these funds?
No. So like we said, so you're buying a ticket to the dividends bus, and as long as you're on that, you're the one benefiting from those distributions pro rata. And if you should decide to get off the bus for any reason, the company will buy your shares back at the then applicable price, which will complete your return profile. So your IRR becomes entirely cash-based, and it'll create an opportunity for the next guy to enjoy the dividends at his yield.
Got it. So yeah, you don't want things being dictated by just like market rates. You actually want to set that true net asset value correctly calculated.
That's right. That's what crushed yield cos are, more or less a failed concept. So that when you take this, if we were to take a portfolio of solar projects like the ones we manage, and to take those companies that you own stock in and go public with them, you would have a yield co. And in yield co, they're susceptible to sporadic buyer and seller behavior, and it detaches the entrance price from the actual value of the underlying assets. So if I want you to get the true return on investment that we work hard to get you, not that you get something less because you got a bum deal getting in.
Yeah. Well, to your point around diversification in each fund, how many projects do you typically underlie each fund?
I mean, right now at Energea, we probably have about 400 projects across multiple managed vehicles. So lots of projects are, cross markets, but some of the funds that we have through the Regulation A process are newer. So like you'll notice the US only has maybe half a dozen projects in it. And Brazil maybe has 20, but they are, it is precisely using the capital that comes through the platform for that purpose.
Last question from me, and then we have a whole bunch of questions from the crowd that I'll get into. What I want to ask you is, you mentioned before we hopped on this webinar that you have a handful of very large LPs, or you have hundreds of millions in assets under management, and you have a handful of very, very large LPs. which I think is great. I think is really actually important for people to know is you look at this as an institutional grade asset or investment product, and there are major LPs who feel the same way. You talk a little bit about their profiles, kind of what they look like. You don't have to mention who they are, and what they kind of found attractive about it as people are assessing this for themselves.
Yeah, sure. And they include the largest, most sophisticated investors in energy infrastructure. One, for example, is Brookfield, a Canadian-based private equity with $1 trillion book. They know the renewable energy space quite well. They wanted some access to Brazil DG Solar. We have loads of it, and we partnered up in a joint venture, and they invested the same way that you could on Energea.com into stuff that Energea originated and in a policy that we selected. So those guys are pretty smart at this. And, we've worked with guys there's a listed trust out of the UK whose stated objective is to invest in renewable energy assets. And that's what we do as managers. So they put in $50 million and so on and so forth. So it's not uncommon for a sophisticated investor to identify the work that we do. That's how our careers all started, servicing the Goldman Sachses of the world. But we also realize that, whether it's a climate change as the purpose or just really seeing more energy infrastructure become quickly deployed and available at good pricing, whatever reason you want to be here, we need broader participation in solar energy. And there's trillions of dollars on the sideline here, and we're trying to create the plumbing apparatus for it to find its way to this good stuff.
I think it's pretty awesome. I'm just such a believer that institutional grade investment should be accessible to the masses, and you're doing exactly that and proving that it's institutional grade, and not because you say it is, but because the institutions are investing with you. So I really think that counts for a lot. I genuinely do, and I think it's important for people to know. Okay, bunch of questions here to get to. First off, why are Brazilian projects bringing 2 times more IRR than American projects? Are Brazilian projects more risky by any chance?
Brazilian projects are more risky, but that's not the reason necessarily that underpins the difference in return ratio. A return on a solar project is quite simply a relationship between the cost of building or acquiring the project versus the value of the energy it produces. When you have really expensive power and really low build costs, such as the case in Brazil, you're going to get a great return on investment. The US is a little bit different. We have things like prevailing wage. So our labor cost to build a solar project is higher than anywhere else in the world by a country mile. We also pay tariffs on the importation of Chinese-made solar panels. Newsflash, all the panels come from China. So you're going to pay a huge tariff as you import that equipment. So to give you an example, for the very same project, imagine if I'm using the same panels, same inverter, same tracker, same everything. That project might cost me 60 cents a watt down in Brazil. That very same project could cost me $2.50 a watt in the US. So you have huge differentiation between the build costs. Good news is energy in America is also sky high. So that's why it's not even worse of a differential. But, when you're in the United States, you get paid in dollars. You have a rule of law that you can depend on. You have a lot of different features to that asset class that is why you're willing to take a 7 in a place like America. If Brazil was servicing up a 7 as well, I wouldn't buy any Brazil. I would just buy American inventory. But Brazil is twice the yield. And that means it can take a punch. That means that foreign exchange rate we could be off on our projections on foreign exchange rate substantially and still beat the United States return on investment. I could lose that court case and still beat my return that I'm going to get for that same project in the US. And that's the concept of risk-adjusted returns.
Next question here. Sorry if I misunderstood. I think the FAQ said taxes were long-term gains, but you're paying dividends as well. Will investors receive a 1099 or K1 form come tax time each year?
No.
Yeah, so I'll take this one. So they're going to get a 1099 at the end of the year, 1099 div, and they're qualified dividends. So they have kind of a special tax, class deemed by the IRS as there's qualified and non-qualified dividends. So because they're qualified dividends, they're going to be treated like long-term capital gains from a tax perspective. So again, we are not tax advisors. Consult your tax advisor for any advice specific to your situation, but 15 to 20%. Most people are going to fall into that 15% range, long-term capital gains. If you have a large investment portfolio and you're in a kind of higher tax bracket, it could be up to 20%, but somewhere between 15 and 20%.
Got it. Do you expect American IRR to go down if the IRA tax credits were to be stopped by the big beautiful bill?
Nope, not at all. Not at all. We have zero exposure to current US based policy. The projects that we own are already operational, they're already selling power. In order to create the 7% IRR we projected there, they need to continue to operate and continue to sell power. And they're long past their exposure to tariffs and changes in policy.
Are the IRRs you were displaying the return we can expect to get, or are there any fees investors will have to pay before getting dividends? And how often can investors expect to get dividends?
Yeah, so the IRRs, that's a great question. Any IRR we talked about, the 7% for the US, 10 for Africa, 14 for Brazil, those are all net of fees. So we do charge a 2% annual management fee to manage the assets, and then there's also per portfolio a carried interest fee above a certain hurdle. And that's all disclosed in the offering circular and numerous places on our website. But the returns that we went through that you see on the website, those are all expressed net of fees. So you're gonna see a 14% return in Brazil. They're not gonna pay a fee on top of that.
For two take home.
Yeah. Understood. Terrific. When you acquire a new solar asset, what does a typical capital stack look like? Do you target a standard debt to equity split, 80-20, or do you vary the ratio? And for the debt portion, which lending partners typically participate? Commercial banks, multilateral development banks, green bond investors, or others?
We buy everything with cash. And the reason why, and now I want upside scenarios. Solar energy is a very challenging asset class, and many have missed on their projections in solar. And it's because they're riddled with debt. They have exposure to interest rate variations. And we don't want that exposure for our clients. So we buy projects almost entirely with cash. I think we might have $5 million out of $450 million that we manage is debt. And the reason why is because we don't want exposure to variable interest rate volatility. And we want to save the opportunity for a dividend recapitalization, or what we call back leverage, which is when we have a nice, big, juicy portfolio of projects that individually they would have been very painful to borrow against. But in aggregate, as a portfolio, they make an excellent borrower for a 30 to 40% leverage stake. So we will likely do that in the future. And if we did that, we would expect to exceed the return expectations we presented here.
What are the risks that I'm not considering with these solar projects?
Yeah, I mean, I think, I'll take a stab at it, and then I'm sure Mike can expound upon it. But I think there's certain risks that all solar projects have, regardless to where they are in the world, the market. So you have something called irradiance, which is just our projections on how much sun we think is going to shine in a particular area of the world. Could be off, could be cloudy, could rain more than we anticipated. The project could produce less electricity than we had anticipated. So there's that risk. I think is common to all projects. I think you have construction risk, which again is going to vary based on market, right? It might be a little bit higher in Brazil or in Africa than it is here in the States. But yeah, there's risks when you're building new projects. And I think, that's why we've kind of shifted gears a bit to focus on buying operational assets or issuing debt to developers to kind of, curtail that risk as best we can. And then I think, you have obviously, people could default. Mike mentioned that earlier. We model in, I think, a 5% default rate. Mike, in Brazil, Mike said it's 2. So we're well within our kind of acceptable, kind of measures of risk there, of a customer just not paying us and having to kind of recapture, replace the customer or repossess the asset. And then in the foreign portfolios, you have foreign currency risk. So in Brazil and in South Africa, we're collecting revenue in the rand and the real, the local currencies respective to those two countries. We're paying operating expenses, maintenance, taxes, insurance in that local currency, and then we're wiring funds back to the U.S., whatever's left each month, and distributing it to investors. So if there's foreign currency fluctuation there, that could certainly be a risk on the two emerging market portfolios.
Understood. Is there a limitation on how much of my stock I can liquidate? Is there quarterly distributions, or how would that work in terms of how much I can liquidate at any given moment in time?
Yeah, so basically there's the 3-year hold period we talked about. So any shares that you sell prior to holding them for 3 years, there's a 5% penalty, early exit penalty to do that. If you're past the 3-year period, there's no fee to sell the shares on the platform. You would just log on to your Energea account, put those shares up for sale, and they kind of get placed into a queue, first come, first serve, in terms of fulfilling those sell orders. It's been about a 10 to 11 day process for investors up to this point. So, we actually feel like that's really good. It's early on. Luckily, we've delivered good returns. We haven't had an inflow of people looking to sell, but 10 days from when you submit a sell order to when that money's back in your wallet is I consider a pretty liquid investment, considering the market is T plus 3. And this is a private investment. So that's a little bit about the kind of liquidity there. But yeah, I mean, there's one other. I was going to say there's one other standard you have to put in. If you're a larger investor, we limit open sell orders per investor to $50,000 an investor. So if you have $1 million, you would have to do 50,000, wait till that's fulfilled, then you could put another 50,000 in. And that's just to, guarantee that some of our smaller investors have liquidity and it's not clogged up by large institutional investors or big investors looking to exit at once.
And even if you wanted to accelerate that, you call Tyler and we figure it out.
Right now, you have investments in the US, Brazil, and South Africa. Where do you intend to go next and why?
Well, we just filed an offering circular for a new portfolio with the SEC last week. It is our Latin America portfolio. I'm constantly seeing inventory from markets like Chile and Colombia being probably the biggest source of new opportunity. I'm over the moon excited about investing in Colombia. I'm heading to Colombia in a few days just for the umpteenth time over the past couple of years, because it's just clearly and obviously going to be a tremendous opportunity for solar energy deployment. So in order to kind of get some access to some exposure to these other Latin American markets, we're dropping the LATAM product here. As soon as it gets qualified for the SEC, you'll see that on Energea.com and be able to participate in that one as well.
Looking at your website, you have a 2.2% return in Q1 2025. Do you expect 25 returns to be lower than the previous year?
No, I think 2025 is going to be right where we want it to be. There's a lot of seasonality with solar, so it's hard to look at one quarter circumstances and try to multiply it by 4. That would not give you the accurate results. And there's a number of other factors that go into these things, but take it from, this manager is under the impression that we're really hitting our targets square in the nose month over month.
Can we invest anytime like a stock, or do you have a round that will close at some point?
You can
Yeah, no, it's an evergreen investment, so it's open-ended. So anytime you log into Energea.com, make an investment, you can set up an automatic monthly investment if you want to do it that way, or just continue to put lump sums in, as you go. So it's completely open. There's no.
By the way, I think it's worth mentioning, Tyler, that's, nothing's open forever. It's open. So we set up a goal to get you guys a 14 in Brazil, to take Brazil as an example. If I can no longer find projects that will achieve that objective, we're going to close the door down and stop raising money for this, put it on the shelf and open up another product, maybe another Brazil product at a lower targeted yield, or maybe we go to Vietnam. I don't know. But what I do know is that while the getting is good and while we're able to achieve our thesis objectives, it's going to be open because we want to mop up as much of that inventory as we can.
Yeah, no, that's a good point. Yeah, basically what happens is obviously, Brazil right now we're getting a lot of offers to buy operational projects that were built within the last 2 to 3 years, which we love, and we're going to continue to gobble those up as we see fit and as they, if it makes sense for our investors. But once that runs out, new projects being built in Brazil right now are not in that 14% net IRR range. They might be more like an 11 or a 12. So we obviously don't want to put an 11% IRR project into a portfolio full of 14s, it's going to dilute our investor returns. So as Mike said, at that point, that's the market will tell us when to move on from Brazil and move somewhere else. Mike can go visit Vietnam for the next 3 years.
And what do investor communications look like? Is there quarterly updates, monthly updates? How does that work?
Yeah, we do a quarterly investor webinar. So every quarter, we kind of jump on a webinar similar to this, and go through a deck, show some videos, and just update our investors as to the status of the different portfolios, what we're thinking about for the future, what's coming, all those good things.
And then we also obviously you get a monthly statement, and you have a real-time live dashboard. So you're kind of permanently have access to what you own. But I think our quarterly webinars, like Tyler said, is where you get your biggest opportunity to learn about what we're doing.
Terrific. That's all the questions I had in my queue. If there's any other questions, I'll give you a minute here. Mike and Tyler, while I have you, I think you mentioned you're a team of 50 full-time. Is that correct?
Yep.
And have been doing this for how long?
We started Energea in 2007. I think there was 17 rather. Sorry, 2017. And we were probably 6 or 7 people heading into 2020. And now, we have a manager in every seat. So we feel like this is our fighting weight to manage up to a couple $2 billion, with this current team of experts that we have. We have an absolutely unbelievable team. Really excited about that.
It's fantastic. Well, this has been incredibly informative. I really appreciate your guys' time. Thank you for what you're building, for all of your insights, for answering all of our questions here today. I highly encourage those of you who are on the call, who are interested in learning more, to schedule a meeting with Tyler or reach out to him with his email that's here. It's been, really phenomenal. I've learned a ton, and I think everyone on the call has as well. So thank you again for your time and consideration today. And thank you everyone for joining. Have a wonderful day.
Thanks, Chris.
Thanks, everyone.